Comcast is the next company. They're about a $125 billion market cap business with revenues right up there with Verizon. They also pay a nice dividend of 3.89, and the P ratio is really low. Now, this isn't a pure play telecom. They do a lot of broadband and they also do media and entertainment. So Comcast runs a TV network, NBC. They also have a movie studio. They have theme parks. So this is a little bit of a conglomerate, but it does have a big communication services business and it is classified in telecom. They are going through the process of splitting the company up, leaving the assets that are telecom separate from the assets what will be more media and entertainment. A little bit, all the businesses that resemble Disney are going to be one company, and then the rest of it's going to be a different company. We'll see when that happens. Now, the stock has not been working, which is why they're probably breaking up the company. Over the 1 year, it's down 12.3. Over the 5 year, not good for investors. Investors have suffered a 5 year period where their money has actually lost value of 23.68. That is not good. I don't care what the dividend looks like. You're losing money. You're losing compared to the S&P. Now, when we look at their revenue, the revenue is flat and growing a tiny bit. No, there isn't going to be a company in this video that's going to be growing at like 50%, 100% or anything like that. The big companies are going to grow just barely, and these guys are fitting right into that mold. They do provide really nice free cash flows of $19.4 billion. They have good gross margins of 70%. That looks really good. And they have been expanding them over time. That looks really good. Geez, it surprises me. And the operating and profit margins are really good. And the free cash flow looks good as well. So it's not growing a whole lot, but it sure makes a lot of money. What do analysts think of this company? Well, we've got 21 of them who are putting an opinion out there, and they think that this stock is discounted by 26%. As we look at the forecast for their revenue, they are growing a tiny bit. They're going to continue just to grow by small portions. Their profits will grow faster, almost double what their growth rate is. And their PE ratio is so low. Incredible how low their PE ratio is. Comcast is a beaten down stock. The stock price has just been going down over 5 years, but it actually presents quite a big discount. This is going to be the biggest discount of the companies that I'm going to cover in this video. 56% discount on this stock. Because when I measure the value of their future free cash flows, 61% higher than their current stock price. Also, earnings per share show that the value of those earnings per share is higher by 42% compared to its current stock price. So this business has been growing their cash flows, has been profitable and paying off debt, by the way, and has created a situation where it offers investors a 56% discount when you compare intrinsic value versus the stock price. They also pay close to a 4% dividend to investors that are stockholders. So that's a pretty strong offer to investors from Comcast.